Welcome to Investment Insights from Opal Capital. My name is Jay Coulter, and joining me are Austin Graff and Adam Mueller. This is a rebranding of our former Opal Dividends podcast to give us the opportunity to speak about wider topics with a wider lens. Let's jump right in. Gentlemen, has the Mag 7 already experienced their best run?
I think that's a great question. And the person that should really answer that is the Fed. Because I think a lot of that run is going to depend on what happens with interest rates this year, which feels like a broken record. I feel like we've been talking about the Fed and interest rates ever since we started doing the podcast. But that's really what it's all about. And if you go with the current projections, if we do see interest rates start to decline or the Fed start to lower rates in the second half of the year, if not sooner, then I think the Magnificent Seven might continue to be the Magnificent Seven. But if we don't, you could see a rotation into some other names, and the run might be over.
Yeah, I think that the Magnificent Seven as a group may have run its course, but individual names within the Magnificent Seven still have room to run. There's a lot of growth and some fundamental tailwinds for some of the names, but then other the names seem like they're kind of stretched given the underlying fundamentals. I think Tesla's an interesting story because you're seeing some significant headwinds in that company from a fundamental perspective that likely don't justify the valuation. So there are going to be puts and takes within the seven, and I think that it might turn out that there are three amazing stocks going forward instead of seven or four. But I do still think that there are some solid winners in the group.
Well, stick around for the end of the broadcast where we do our bull and bear segment. We will have Tesla and some of the other Mag 7 names in that segment. Let's move on to China. Equity valuations over there right now are quite interesting from a historical perspective. What's your take on investing in China today?
Well, first I'd say it's very interesting what's happened over the last 7 to 10 days or so, where China, which feels like it's in a I guess we'd call it a housing-driven recession, saw the government start to make some noise about injecting money and rumors of stimulus, which caused the stock market to just pop off of, I don't know if we call it historic low valuations, but low valuations. And I'm not sure that the government has followed through on that yet, or what the time horizon would be. And it just feels like, even over the last 10 or 20 years, the government says something positive about how they might try to influence the Chinese stock market, and that results in a lot of volatility.
This is a great situation where looking in the rearview mirror is a very difficult way to kind of judge what's going to happen in the future. So China's got a lot of moving parts going on right now. Like historically, China was the fastest growing kind of large economy, and a big part of it was because of the U.S. outsourcing to China. As that's slowed down, you've got some demographic issues as well as some, I would say, natural resources issues locally that are causing some headwinds for the economy. And so it likely doesn't justify the premium valuations relative to other emerging economies that we've seen out of China historically. So what looks cheap today might not actually be as cheap as it looks as we see the longer term fundamental picture play out.
And I think some of the information that can be the most interesting about China is to look at large U.S. companies that have a significant China presence and what they're saying on their earnings calls about China. Just to pick one, General Motors, a few years ago, their Chinese business was a bright spot and something that they pointed to as a growth engine. It had a tough year, and they're guiding for another tough year in 2024, which kind of tells you that, it doesn't feel like China's going to turn around anytime soon.
Some of that has to do with the local players, right? There have been really aggressive stimulus and incentives for local car makers, and you're actually seeing some of the Chinese car makers take out some of the European car makers in Europe because they've got so much momentum underlying their businesses from the stimulated growth in China, and they're starting to branch out internationally. I think one of the really interesting stories to watch for a China REIT is Starbucks. Their big growth story right now is actually expansion into China. If you look at many of their investor presentations, a lot of their materials are talking about the penetration of coffee in China relative to the US. And how that story plays out will probably tell us a lot about how the Chinese consumer plays out, because the story to date has been a premiumization in the Chinese economy with the Chinese consumer. And it's unclear if that can continue, or if there are legs for that into the next kind of 3, 5, 10-year time frame.
Well, so a follow-up question, gentlemen. Does China belong in a diversified portfolio today?
Hard to ignore it as the second largest economy in the world, but hard to focus on it given the structural headwinds that are in place for the economy.
And I'd also say it's hard to avoid it if you're buying larger cap companies. I don't think a diversified portfolio today needs to have Chinese companies per se. I think if you own things, and I'm if you own, I'm not going to say any names in the context of this question, but if you own almost any large multinational US company, you have significant Chinese exposure. And so you're going to get the diversification whether you like it or not.
Let's move on to the Fed. So we're recording this in January of 2024. Fed meetings this week. Tell us, gentlemen, what do you see on playing the rest of the year as it relates to Fed moves?
Well, I've made my own dot plot of the Fed moves in 2024, and here it is. Can you see that? It's empty. And yeah, that's, I'm exaggerating for effect, but I think all of these estimates about the number of rate cuts, I'm a little sick of it, to be honest. I think it's a little bit ridiculous, because really what no one's talking about is that rates have just sort of normalized at this point. Just because we lived through, post 2008, the post 2008 financial crisis, for whatever it was, 15 years, we had zero rates. 4 or 5% is just a normal, business as usual type of rate. So to think it's going to come down in any meaningful way when the economy hasn't cratered, I'm not quite sure what that thought process is.
It seems like talking heads are kind of making up an issue with the real rate concern. Like they're saying like, oh, with where, inflation has dropped so much that real rates are significantly greater, so it's causing more stress on the economy. And quite frankly, we haven't seen that stress flow through to the economy yet. If we start to see more issues in the economy, then we'll probably see more aggressive rate cutting. But barring any significant issues, barring a real slowdown, as we're almost a full month through, or a full month into 2024, I don't see the 4 to 6 rate cuts out of the Fed. I think it's more likely, if you do get a cut, it's that the Fed is kind of submitting to this real rate concern that a lot of people have. And they're also submitting to the fact that we're in the midst of essentially an election year. And so they feel like they have to support the economy, and they don't want to see any major blowups. So you might see, call it 1 to 3 cuts, but I reserve the right to change my mind if we have any significant economic events that happen. And quite frankly, we'll probably see a significant economic event given how much interest rates have changed over the last 24 months.
I mean, whatever happened to the Fed monetary policy as a gas pedal, right? And when the economy's running too hot and inflation is too high, you ease up on the gas. And when the economy is running too slow and there's no inflation, you lighten up, you press down on the gas. If that's the analogy, which I feel like it was forever, then aren't we just in the middle right now? And if you're in the middle, wouldn't the projection be nothing happens until something happens?
This whole forward guidance thing out of the Fed is just ridiculous. I mean, they're not very good at telling you where the economy is today, let alone where it's going in the future. So who knows why they feel like they're qualified to provide forward guidance. All it does is create a lot of confusion and more volatility in the market. I think the only reason they provide the forward guidance is because it makes them more important in the news cycle. So it's more of an ego play than anything else.
Interesting.
It's something for CNBC to talk about.
Speaking of talking heads in the news, it's hard to turn on the television and not see somebody trumpeting the idea of a soft landing. Gentlemen, do you think the idea of the soft landing is just a narrative or something we might actually experience?
It's definitely overplayed. It seems like every market forecaster, every economist is assuming that the base case is a soft landing with lower rates. And that just doesn't seem like a high probability outcome. It seems like we're either going to see a significant slowdown, and that's what's going to drive rates lower, or we're going to see a stronger economy, and rates might drop a little, but they're not going to drop significantly. So if the assumption that, the economy is going to gradually slow, everything is going to remain just fine, and the Fed's going to drop interest rates by 2%, that seems just ridiculous. For anyone that actually understands economics and markets, that's like outrageous. But when you put the entire market together, it seems like everyone seems to be running off the ledge together. So I think investors would be smart to kind of look at the options on the table that are more likely to happen, but are not necessarily priced into markets. And those would be higher for longer with a growing economy or some type of economic issue that forces the Fed to radically reduce rates.
Yeah, look, I think soft landing is a term that was created so people can get paid to go on business TV and spend 10 minutes saying absolutely nothing. Like if the definition of a soft landing is you're 4 to 6 quarters into a Fed hiking cycle and the economy hasn't fallen off a cliff, then we're in a soft landing. So what? And then if another 2 quarters or a year from now we go into a recession, does that make it all of a sudden it's a hard landing? No, it's just semantics. It's just a way of saying that the Fed has been raising for a while now and it hasn't cratered the economy. That's all, to me, that's all it really means. And sure, that's what's happened empirically. That's where the economy's at. But to continue to speculate on whether we're going to have a soft landing, whether we either already have or we haven't. And the reality is that the economy seems to be doing pretty good given the historically high rate hiking cycle. But remember that the rate hiking cycle started off of essentially zero rates. So even if we're still just at a normal level.
Let's not forget that the Fed nearly crashed the plane last spring with the regional banking issue, right? Had they not swooped in and offered some ridiculously easy policy for the banks to fund their balance sheets going forward, we would have had a catastrophic event in the economy. And that's going to take a while to work itself out, right? So this whole idea that, we're in a soft landing versus hard landing, historically, they didn't use tools like a facility that allows banks to essentially park bad assets on the Fed's balance sheet at very minimal cost until they work themselves out. So the Fed's been, I would say, manipulating the market for some time. So it shouldn't be a huge surprise that we haven't had any significant issues, but that doesn't mean that we won't have a significant issue in the near future.
Today, UPS announced 12,000 more job cuts. It seems like every day you turn on the news, some companies laying off some percentage of their workforce. How are you guys looking at job cuts today?
Well, with growth slowing, right, it's hard for companies to outgrow the broader economy. And the whole idea of a soft landing is that you have growth coming down. Some of that's because inflation is dropping, but some of it's also just because, real growth is dropping at the same time. So as you have less growth in the economy, for companies to be able to produce the margins that they expect to produce, they're going to have to start laying off some of the less productive workforce. And we're seeing that pretty aggressively, not just at UPS, but we're seeing it at many tech companies. I think Block just announced another 1,000 jobs. Wayfair recently announced a significant layoff. We've seen layoffs at Microsoft, at Amazon. Like all the big names are laying off people, and it's because everyone's trying to achieve margins or attain margins in an environment that has slower growth, which just makes it more difficult.
Yeah, and you look at 2 years ago, tech had a really tough year, and then last year the tech names were on fire. And the market rewarded them for every earnings report when they announced more layoffs, and rewarded them for focusing on margins and focusing on cost structure. I think the only thing about UPS that I would take note of is I think there's also a normalization going on in the economy with respect to this sort of bubble of kind of online purchasing that happened when the economy was closed because of the COVID pandemic. And there was a lot of hiring associated with that. And I'm not sure if some of this is kind of trying to right size back to kind of a more normal growth glide path. And I think you've seen that in a lot of businesses that just overhired related to the pandemic and are now trying to kind of get back on track, as well as realizing they're going to come under, they are or will be coming under margin pressure and trying to get ahead of that.
Yeah, that's a good point. I think a lot of companies significantly overhired when there were few people on the job market, and they didn't let go of people that should have been let go. So we're seeing some cyclicality here, as you should see cyclicality throughout the economy. It's not a huge surprise, but I would be interested to see if the Fed's trying to engineer their way out of cyclicality in the labor market. I think that would be a bad thing for everyone. But it wouldn't surprise me if they weren't trying to reduce layoffs in one way or another.
I think what's also interesting about the UPS announcement was, in addition to the job cuts, they also announced that everyone is now expected to be in the office for 5 days a week, which is also something that, is getting back to sort of a normalization of just how work occurs. And if there is a productivity bump to being back in the office, you might need a few less people. And then there's the question of, is AI having an effect on the number of people you need yet? Is that already starting? I'm not sure that, I'm not suggesting that the UPS job cut is because of some AI system they've put in place, but isn't that part of the AI story is productivity, which ultimately leads to job cuts?
Let's be clear, the UPS job cut of that magnitude is primarily due to the labor agreement that they signed last summer, right? You basically transferred a lot of income and wages to the drivers from management, and now they have to hit margin targets. So they're cutting away at upper and middle management, trying to hit certain profitability levels. And so it's a trade-off. These things all kind of go, and it's a pendulum swinging back and forth. And you're seeing with the labor tightness that we've seen over the last 3 or 4 years, actually 2 to 3 years, you're seeing more of the, I would say, profitability move to labor from management. And that's being kind of demonstrated in this pretty significant layoff in UPS management.
Earlier, we were talking about bank stocks and how the Fed had to come in early last year and essentially bail them out. How healthy are the banks today, and how are you guys looking at them from a portfolio perspective going forward?
I think the banks it's probably a more dynamic market today than what we've seen in a really long time. And there's a big, I would say, differentiation here between regional banks and between the money center banks. So last year, the regional banks got hit really hard because many of them either had really, I would say, suspect asset portfolios because they had a lot of commercial real estate, or they had gotten over their skis with deposit pricing, and they had invested in a lot of longer dated securities that all of a sudden were underwater, and it created a liquidity crisis at many of the regional banks. The money center banks didn't have this issue. They actually benefited from the regional bank issue. But then towards the end of the year, regulators came out with extremely strict capital targets and regulations for the money center banks that kind of created a dark cloud over the story for the JP Morgans, the Morgan Stanleys, and the Cities of the world. That regulatory picture seems to be easing. There were reports that the money center banks in the U.S. would have to hold 2 to 3 times as much capital as European banks in similar business lines, and that just didn't make any sense. The banks have been lobbying aggressively to reduce these capital requirements, and it seems like they're starting to get some traction. So banks are pretty cheap from a historical perspective. We think the money center banks in particular could be an interesting opportunity if these regulatory capital requirements get rolled back a little bit. We'd be a little leery of the regional banks, as there's still a huge commercial real estate component to their asset portfolios, and it's not clear to us that we're receiving the all clear sign on commercial real estate right now.
All right, gentlemen, let's wrap up with our bull or bear segment. As a reminder, whoever gets the stock, you only have 60 seconds to make the bull or bear case. Adam, we're going to start with you. Apple.
I'm a bear. I love Apple, I should say, but I'm a bear at these levels. I just think it's the law of large numbers. The company's become very, very large. Even if Microsoft recently passed it as the largest market cap company in the world, Apple is still a multi-trillion dollar company. Everyone I know already has an iPhone, so there's a limited there's a limited cycle in terms of upgrades. I know they have new headset. I don't know if it's pre-orders or if they're starting to show up now, or at least the review embargo came out this week. So people are, and it sounds like an incredible device that I would not personally buy because it's just too expensive. And maybe in a few generations of the device later, it'll come to be a reasonable price, but is it really going to be a growth driver? So, I'd stay on the sidelines at this price point, but great company.
I look forward to doing a podcast with you in the future with your headset on, Apple or Adam.
Yeah. Yep. They look good. We could all have them on. Yeah. All right. So next, Bull or Bear, Austin on Netflix.
I'm a bear on Netflix, primarily just because it's starting to look a lot more like traditional TV. As they get into, live sports, they get into commercials. How is this different than traditional linear TV, other than they have some pretty good content, which they pay a lot of money for? So I think that the growth story might be behind it. We might be looking at more of like a normal kind of grower with attractive margins, but not the explosive margins that we've seen historically. And you might see a valuation normalization as the market starts to realize that the most attractive growth prospects might be behind them. I mean, they're looking into video games now. I think it's an interesting opportunity, but I just don't think that they're going to corner the market in all entertainment indefinitely.
Adam, Bull or Bear, Tesla.
I'm a bear on Tesla. Look, I think if you bought Tesla 12, 14 months ago at under $100, you doubled your money. Why are you waiting? Pull the trigger, take the cash and run. I just think it's the multiple was reasonable for the first time ever at 90 or $100, and then it got up to 200 and something. And where's it sitting now? Just a shade under 200, but paying 45 times forward earnings for a company that is facing more competition than ever, always has manufacturing hiccups, needs to invest a lot of money in manufacturing facilities, is levered to China. There are a lot of reasons why I think the risk reward on Tesla is pretty dicey right here.
Austin, Bull or Bear, Devon Energy.
I'm a bull on Devon. It's had an interesting story over the last, call it 24 months. It was a darling of the oil patch for about a year and a half, and then all of a sudden it became the dud of the oil patch for the last year. A lot of that had to do with the fact that they had higher or more expensive supply contracts that lasted longer than other participants, so their margins contracted for about 12 months, and now we're rolling off of some of those more expensive supply contracts while oil prices remain at relatively attractive levels. It doesn't require oil to be at $100. It doesn't require oil to be at $80 or $90, but $70 to $80 oil will be a great cash flow generator for Devon, and we think that over time that's going to be a great capital return story for investors.
Austin, let's stay in the energy space. Bull or Bear, Chevron.
Chevron, again, we're a bull, or I'm a bull on Chevron. It's one of those that had its own issues last year. I mean, historically, management's been kind of at the top of the game in the oil space, and they've been revered as one of the best management teams in the space. They had some hiccups last year, some execution issues, and the market punished them for that. I think that this is the opportunity for them to prove themselves. While they do have some pretty decent assets that should generate decent returns going forward, as the market starts to see management executing in a more favorable fashion, I think the stock has room to go up from here.
Adam, let's close with this. Bull or Bear, General Motors.
Oh, huge bull on General Motors. Look, General Motors reported earnings today and they beat, but more impressive was the forward guidance, which we all should have seen this coming. Last year, they announced a $10 billion accelerated share buyback when their market cap was something like $40 billion. Like, they bought back a quarter of the company in one go, which suggests that they are bullish on their prospects. And they're talking about doing another $10 billion of free cash flow in 2024. And the market cap is at something like $50 billion now. That's still another 20% of their market cap in free cash flow in 1 year. They went through a tough labor negotiation this year, and it felt like the labor unions did pretty well, but looks like you could have done better. Because they're making money hand over fist, it looks like. And barring some sort of setback or the economy rolling over, it looks like, how can a company trade for 5 times earnings when they're actually growing?
Gentlemen, that wraps up this show. To learn more about Opal Capital, please visit opalinvest.com.
The viewer of this content should not assume that any information presented or made available on or through this media channel is receipt of or substitute for personalized investment advice. Opal Capital, LLC is an SEC-registered investment advisor. Registration with the SEC does not imply a certain level of skill or expertise. Opal provides its services exclusively to registered investment advisors, either through a sub-advisor relationship or a model provider consulting arrangement. For a copy of Opal's disclosure documents, please visit advisorinfo.sec.gov and follow the search instructions. Visit opalinvest.com or opaldividendsdigest.com to learn more.